What was the stock that you bought this week?
Micron, of course. So if you remember, I did three tranches of sales, totaling roughly 7.5% of my Micron holding. I had sold it in 2.5% increments. I'm basically buying back those same shares that I sold between 1,050, I think, and 1,200 bucks. I'm now
Mm.
buying them back. I bought yesterday. I bought some in the 800s, and today I bought some in, like, I think it was like 760 or something like that. Um, so two of those three tranches have been purchased back because I missed them. Those shares left me, and I missed them. I wanted to have them back. So, and who knows if the price continues to crash as it has been, I might buy that third tranche. Now,
Mm.
um, what's fascinating about Micron's price crashing is the circumstances under which it's crashing, so, which absolutely are mind-boggling to me. One of those circumstances is CXMT, as you just mentioned, Chinese memory maker, going public in the Chinese stock market. And the Chinese investors decided this is the most valuable company in China and rode that company to over a $500 billion valuation, which is absolutely incredible. It's awesome. They have the right mindset. Memory is super important. They kind of are validating the fact that memory is super important. And it turns out that CXMT has roughly an 8% market share of memory of the DRAM market. Um, so then the question is, um, if 8% of the DRAM market is worth 500 billion, how much is 22% of the DRAM market, which is what Micron has,
Mm.
worth? And if you just extrapolate it, it's at least worth 1.4 trillion. So that's like one particular viewpoint on it. And if you do, 1.4 trillion dollars would be roughly a $1,250 per share price for Micron. That's just on this DRAM market share. But then Micron has more advanced memory, and they have the AI high bandwidth memory that CXMT and others can't, or the other makers besides CXMT, Samsung, and SK Hynix are not there yet. So um, CXMT can't make these memory chips that Samsung, Micron, and SK Hynix can for AI usage. So that's fascinating. Like, why should this stock be hit as opposed to go up because of the CXMT IPO? Makes no sense. So at least to me, it makes no sense. So that's one of the reasons it went down. Um, another reason was that Google reported, as you know, last week, and they
Mhm.
crushed it. They crushed it on revenue growth. They crushed it on EPS. Now, part of their EPS was due to one-time profits from the SpaceX IPO because they own a big chunk of SpaceX. So, but overall they crushed it. Now, what's the reason that Google crashed and the earnings were viewed negatively? It's because for the first time Google actually had negative cash flows. So, despite having record profits, because they're deciding that, hey, AI is pretty important and they're going to spend even more money on capex and data centers, the market has decided to punish them for that. Okay, but what does spending more money on AI and data centers mean to Micron? It means that more memory chips are going to be purchased, right? More Nvidia chips are going to be purchased, and ironically, both Nvidia and Micron have gotten hit because of that too. Makes no sense to me, but this is the sort of like the way the market has decided to react. And then last night we got word that SK Hynix reported and they missed estimates. Now, what does missed estimates mean? It means that their revenues were only up 275%. Their profits were up over 500%. And they only made $41 billion of profits in the last quarter, which if you
Oh my.
extrapolate for annualize that, that's like roughly a $200 billion profit annualized, assuming they don't grow from here on. So $200 billion of profits is more profits than any company in history has made historically. Certainly any American company. Um, and, uh, and then the market has decided that, you know what? SK Hynix is worth less than $1 trillion, despite it's a pump out 200 billion in profits per year. And of course, we got Micron get hit because of that news as well today. So the combination of things. So there's sort of like the story and narrative that moves stock prices, because what is the stock price? The stock price is just a reflection of buyers and sellers. If there's more buyers, the stock price goes up. If there's more sellers, the stock price goes down. So it's as simple as that, right? Like fundamentally, that's what a marketplace is if there's more buyers, stock goes up. If there's more sellers or whatever it is, not just stock, right? It goes down. So what creates more buyers or sellers? The story and narrative is what creates it. So Michael Berry comes and says, oh, I'm shorting Micron and Nvidia and the whole AI trade. It's all bullshit. At the same time, we get like Jim Cramer going sour on data centers, and like these are just narrative stories, right? This is not reality or actual things that are happening. What is happening is that these companies are still crushing it. They're still spending a lot on capex. So the reality and the stories don't match up. And whenever the reality is way better than, at least so far it has been, way better than the stories that people are telling, which is that everything, the sky is falling and everything is falling apart. When those things are a mismatch, it creates opportunities, which is the way I'm viewing the market. And that's why I've bought back some of those Micron shares that I sold. So, where can you buy a company for 5 times profits, the next year's profits? When have I ever been able to do that? That's just such a rare circumstance. So if Micron profits, by the way, just for sake of argument, expected profits for the next year were to halve, like down 50% from what they're expected to earn. So instead of earning, something like $120 billion over the course of the next year, they only earn they make only $60 billion worth of profits. Well, what's a $60 billion profit company worth, right? If it's worth, 15 times that, 20 times that, it's still a $1 trillion company. so it just makes no sense for it to be trading where it's trading. And that's assuming a 50% discount on the expected profits. So if the expected profits happen to materialize or even be beaten, then the opportunity is even greater, right? So seems like a no-brainer.
Yeah, I agree with all that. Personally, as you know, I bought my first round of Micron shares at around $350 a share. And then I bought more after Micron corrected to, I think it was like $913 a share, which looking back, I should have waited a little bit longer, but you just can't time these things.
There's no way to know, yeah.
Right. I would love to be buying more here. I'm currently like maxed out on my target allocation. So if Micron continues to fall, there's a good chance I do buy more. But we'll see.
One thing that the market has taught me multiple times is that no matter what the price is, it can always go down further. Yes. Right? Like that is one thing that is universal. And that's why, like, when people say, oh, has it bottomed out? Or like, is it time to buy? My answer is always, I don't know. Like, there's no way for me to know. Nobody has a crystal ball. And anybody who confidently tells you one way or the other that from this point forward, it's only going up or it's never seeing X dollars again or whatever, anybody who speaks confidently in that way, like Jim Cramer yesterday was like, at open, you should sell if you own any data center stocks, especially on margin. Now, if he had just said, if you own anything on margin, it's not a good idea, right? Like, you shouldn't be buying on leverage. And you should just, like, think about getting off margin. In general, I would think that would be good advice. But he's like, no, definitely sell at close. You will not regret. I'm like, okay, clown. Anytime somebody says something with so much confidence, they're a clown, right? There's no way to know with that level of certainty any of this stuff. So it's always speculation, first of all, and then within the speculation, we're just trying to decide which opportunity is better than another opportunity, right? And fundamentally, that's what we're doing as investors.
But that's what listeners want. They want someone who just knows the future. Do you know how many subscribers we would have if we just told everyone exactly what was going to happen?
What to do with absolute certainty. You know, what's
Yeah.
funny is that Jim Cramer in particular, just to pick on him for a little bit, because he's been sort of like he's done some very shady things for a very long time, but he also sells this sort of CNBC investment club. He's sort of like a key person behind that. And I was trying to determine what is the performance, historical performance of the CNBC investment club. You cannot know. It's like totally opaque. Nobody knows that. Nobody knows Jim Cramer's performance, like except for Jim Cramer, obviously. So there is no way to even determine whether or not some of these guys are legit or not. And then when you look at sort of like Michael Burry, who, you know, obviously the Big Short movie was made about because of a great call that he made in 2008, you know, shorting the market back then. And because of that fame, you know, he's super popular and people listen to them. So when he says, I'm shorting Micron or Nvidia or the whole AI trade, or these guys are all fudging their books and numbers, people listen. But what's his track record? Oh, it turns out for the past, you know, 3 years, he's actually been negative. And for the past 5 years, cumulatively, he's made 15%. His portfolio has made 15%, where the S&P 500 has made 68%. So he is literally like the S&P had, you know, just this random index fund that anybody could just put money into with no time or effort or thought, has outperformed Michael Burry's performance for the past 5 years on average by 350%. Meaning you would have 350% more returns within the S&P 500 than you would with Michael Burry. So, you know, why are we listening to this guy? Like, what's the reason that we're even taking this guy seriously? It's baffling to me that we put so much emphasis on some of these things.
I think part of it is you have investors that don't understand the fundamentals of the company. So when they see this headline, they're like, "Oh, Michael Burry must know more than I do,"
Right.
and there's a bit of like, I guess the opposite of FOMO or FUD, fear,
Right.
uncertainty,
Right.
doubt, that
And
takes hold.
you know, we do make these heroes in our society, and then like whatever the hero does, that the hero is correct, right? Like, so, you know, in a way, he's looked up as the hero who went against the grain in 2008, and was right. But there's a lot of people who were like calling that. No,
Right.
most of them, I didn't get a movie made about me from 2008, but I
It's
also
coming.
happen to call it, you know. Yeah, the movie is in the works.
It's coming. And by the way, that's roughly 20 years ago already. Like,
I
it wasn't
know.
like this was a
It's
great call yesterday. This was a great
right,
call 2 decades ago.
right.
I do want to go back to Micron's price falling and predictions. Not that I have one, but I do want to talk about precedent. And I know I've mentioned this several times on the podcast of how I like to compare NVIDIA's run up and corrections to Micron. The largest NVIDIA correction was 43%. If Micron were to crash 43%, that would bring it to $715 a share, which we're actually pretty close to right now.
Mm.
That's not to say that Micron can't go below that. It most certainly can. But I just want to call out there's very much a precedent for the price to go down this much. And you don't necessarily need to worry. There's nothing broken in the core thesis of the company.
Right.
So
To
there's
be
very much
clear, the
precedent.
company itself has not said that they have any concerns. Everything that the
Correct.
company has said is that they're sold out for the next year and supply will be tight, likely into 2028 and potentially beyond. And they have just increased their expectations of revenues and profits for the next quarter, and for the foreseeable future. And by the way, they have said that they have now long-term contracts with their customers to the tune of roughly $100 billion of pre-sold memory chips at set prices, or with floor pricing, meaning like it cannot be sold for below a certain price or above a certain price, to sort of protect the customer and to protect Micron. So, you know, the combination of the reality of what is actually happening versus the narrative and the stories, there's a major disconnect, and I think that's the thing that I keep top of mind as I'm trying to make decisions, and the FUD goes crazy and everybody's looking at, oh, is the sky falling? Is it about to be over? And it's like, all right, I've seen this story before.
Right. And that's exactly why you're buying.
That's right.
Hi, Dustin and Hamid. How do you all feel about daily leverage tickers in the memory sector, such as RAM and MUU?
I'll let you respond to this first, Dustin, and then I have my opinions.
Yeah. So my bias is against leverage. I think as an investor, one of the emotions you need to manage the most is greed. So an easy rule of thumb is to just stay away from leverage. With that said, if you are looking for leverage, I do think one of the better ways to, one of the better instruments to use is one of these ETFs. I personally don't touch them, what I said, based on prior. And for example, by the way, when Micron hit $1,000 a share, and a lot of us were thinking, oh, it's going to $1,800 a share or $2,000 a share. You just don't know. So if you're levered up and now all of a sudden it drops down to $750, it's harder to stomach that when you're in one of these ETFs.
Right.
So, it doesn't matter how confident you are. I just rather personally invest my own dollars directly into these companies as opposed to these third-party levered mechanisms.
100%. I agree full-heartedly. I think it's a bad idea to be on margin because you never know when things can get bad, and then when they get bad, they can always get worse. So, and the only way to be able to ride it out without sort of this mental meltdown, if you will, is to not be in a position where you're getting margin calls or pushed to sell something. Levered ETFs are slightly better than doing margin on your own, but not much better because they're still going to go down rapidly as the stock prices go down as well. So managing
and by the way, even if the company or the stock is set up for success, there's always macro factors or just random, just totally irrelevant factors that could fluctuate the market. Right. So in this case, oil prices are increased, and that's driving the market down a bit. And that's maybe something that you took into account, or maybe something you didn't take into account. But it's very difficult to know, no matter how confident you are in an individual stock, you have to be confident in the broader market too.
That's right. Let's do
it. Let's talk a little bit more about Micron. Would you buy Micron options at these prices?
Similar question.
Yeah, well, I mean, it's not leverage though. So if you're using cash to buy options, that's a different story. The way I would view, or the way I do view, not I would view, the way I would I view options is that it's sort of a gambling.
That's why I'm saying it's similar.
Well, it's the leverage is different because you're borrowing to buy something, right? And that's way worse, in my opinion, than just gambling money that you have, right?
I don't know that with both you could easily end up where you're at zero.
With leverage, you can go below zero too, which is kind of crazy.
Not with the ETFs, though.
No, right? Not with the ETFs. That's right. That's right. You're correct. But with options, that's the way I view it. So then I'm not dead set against gambling, but I look at it more as a form of entertainment, and not from a form of investment. And then it's every now and then I'm like, okay, this would be fun to gamble on just to see whether or not I'm right about this or wrong. And I do it. I do buy options occasionally, but it's significantly less than 1% of my portfolio. So just so you understand, that's the level of which I'm comfortable gambling. And that's the way I would view it. I wouldn't view it as investment. Now, if you happen to be right, it could easily have huge returns. Options are ways to make 10 times your investment money on options if you happen to be right, but it's also the vast majority of the time you're not right and it goes to zero. So just so you understand, the price is baked in so that you're not right. majority of the time. So keep that in mind.
Yeah. The problem with options for me is not only do you need to be right about the direction in which the stock is going to move, but you need to be correct on the timing. And this might sound easy. You just need to be right about two things, direction and time. It makes it so much harder, at least twice as hard, right? It's a second vector.
That's right.
It's really, really hard to do both of these things correctly. And the market moves in ways, obviously, that no one understands, right? Like, again, going back to Micron, it was at $1,000 a share. You kind of think, okay, it has a lot of momentum. It's going to keep going. Maybe you buy some options and all of a sudden it tanks to $750. Your options aren't doing too hot, as opposed to owning shares.
And they might expire soon. So it becomes worthless.
Right. As opposed to owning shares, let's say at $1,000 you buy 10 shares and then it drops to $750. Well, you still own your 10 shares of Micron. That's not going away. So as long as you still have that belief and you're a long-term investor and you could ride it out, maybe it is going to 1,800. And you're still going to get there. You're just on that journey, and owning the shares directly allow you to be a part of that ride, as opposed to trying to take these shortcuts. So that's my view.
If you enjoyed this clip, consider subscribing to the Buy Hold Rant podcast on YouTube, Apple Podcasts, or Spotify. New episodes are released every Wednesday, and you can watch them live on YouTube.